Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories by Village Global. I'm here today with two very special guests, Olaf Sakkers and Prescott Watson of Maniv Mobility. Guys, welcome to the podcast.
Good to be here.
Good to be here.
So, Olaf, why don't we start with you? You started Maniv with another partner in Israel. Why don't you give a little bit of a historical background of Maniv, its focus, and then we can get into Prescott and talk about how it's evolved over time.
Yeah, so I was living in Israel. I was in the IDF, and I started looking into autonomous vehicles. Written a paper, met Mike, who was an early investor in Better Place, and basically had this idea that Israel could become a key center for development and innovation around the theme of autonomous vehicles. So we started meeting these companies that were being founded by kind of tech veterans, people who'd started a few other companies, say a data marketplace or a cybersecurity company. And they were doing things that were now becoming relevant to automotive. What they didn't have was connections into the automotive industry and a way to basically bridge across that gap. So we started kind of instinctively helping them to reach their customers. Mike, from his background at Better Place, had a pretty strong network there. And then over time, as we helped more companies came to us, and then it became kind of a virtuous cycle that we were making these effectively angel investments into companies, building out a portfolio in the mobility space. And as that portfolio grew, we kind of developed a reputation and raised our first fund on the back of that. And now in July, we closed our second fund, which was $100 million USD fund with a lot of backing from strategics like major car makers, suppliers, oil and gas companies like Shell. So that's been kind of the evolution over time. With the core idea kind of at the center of it, that we don't just give capital to our companies, we help them reach across the industry. And because we're so focused on mobility, we're able to add, I think, pretty unique value and see repeating patterns, get what we like to call economies of scope from focusing on the sector and having relationships across it.
Cool. And Prescott, what's your story here and where are you most excited?
So I ended up moving to Israel in 2012. The reason I moved to Israel most directly is I had an opportunity to work with an entrepreneur that was starting a company. I'm an American, no connection to Israel. So a lot of people ask, like, why Israel? Hindsight's 2020, so it's always easy to kind of paint a story of why you end up in a certain place. But if you were to just kind of close your eyes and throw a dart at the earth and ask, what tech ecosystem you're going to end up in if you want to work for a startup. Surprisingly, Israel is actually a pretty notable ecosystem. It's not actually that surprising if you want to move somewhere to work in tech that you end up there. So I moved out in 2012 right after college to go work at an early stage startup. And I was there for about 5 years, during which time I got to see a lot of the trends that were happening there. And I think when people ask, like, what's going on in Israel, there's always numbers you can talk about, like IPOs, capital raising, M&A, that kind of stuff. But I actually think talking about it in terms of products is more interesting. Some of the stuff that was really amazed to kind of learn when I moved there is how many of the products we use are from American companies, but really developed by Israelis or developed in Israel. So, when people ask about what's going on there, I point to companies like Intel, for example. I think people are always surprised to know that there's certain years in the past decade where it's like half of Intel's global revenues came from products that were made in Israel. Or if you look at like Apple, for example, the acquisitions they made in the past few years power a lot of the flash memory in their computers or in their phones, power the products like Face ID and other things of the sort. So it's actually, if you're just going to go somewhere and work in tech, Israel's actually surprisingly a close second to Silicon Valley.
Totally. Now, what is the Maniv Mobility investment thesis today? Where are you guys focused? Where are you guys interested? I'm curious to dig in what today is interested in mobility space and maybe in contrast to how that's changed in the last 5 years or so.
Yeah, so often the first question we get asked is like, what is mobility? And our quick definition is things that move people and goods. And I think the definition initially when people meet us are like, you're a VC that focuses just on mobility. That's so narrow. And then when you kind of describe this, then they kind of have the opposite reaction. It's like, how do you focus within like all that stuff that's happening? Because there's a lot of technologies that have been developed over the last few years that are relevant to the space, whether it's connected technologies enabling data to be shared between vehicles or sold, or cybersecurity that protects vehicles. Changes that are happening to the powertrain of vehicles, like electrification. Everybody knows Tesla, obviously, but that's a huge shift happening in the industry. Obviously, autonomous vehicles. But I think what we're finding now is that there's a really interesting shift around the business models. I mean, it's continuing to happen. Like the most valuable startups of the last decade have been companies in the ride-hailing space, and companies like Uber and Lyft and Didi. And also now scooter sharing companies. So you're seeing this opportunity to change how people get around and what kinds of vehicles they use to get around. And so I think what's nice about being focused is that we're able to come up with pretty deep ideas about how all these things fit together. We're kind of thesis driven. So one of these ideas is around like a trip economy, that once you start buying a trip on Uber, it's not so crazy to also buy a trip on a shared scooter, or to buy a food delivery trip that's basically brought to you. And the car historically has been this bundle where you spend, thousands of dollars every 5 or so years buying a new car. And that car is like a decathlete. It's kind of good at everything, but not great at anything. And as a result, you kind of have something that on average does all the things you need it to do. But when you start buying trips, you start using the vehicle that's optimized for whatever you're doing at a given moment. So micromobility is popular because cities right now are super congested, and sitting in a car is not so fun, and you can get on a scooter and you can get there faster, and you'll get some kind of fresh air in your face along the way, or food delivery kind of saves you time. So what we're seeing is this fragmentation of trips that historically have all been bundled into the car. And then specialization of different vehicle platforms for each of those trips. So that's one thing that we're really excited about right now. And we're seeing it play out in different ways in developed economies and countries, and then in emerging markets.
What are examples of investable companies that emerge from that thesis?
So we've got a company that kind of leveraged the shift in food delivery, which is quite interesting. Actually, there's some PR around the round today. Called Bolt Bikes. And what this company does is it leases electric bicycles to food couriers. So I noticed when I was riding around in Paris on a jump bicycle, which is like a pedal assist bicycle, that I was riding kind of faster than a lot of the couriers. And these couriers are spending their entire day riding around the city making money, but they don't have the optimized vehicle for it. And so part of the challenge is they don't have access to credit, or they don't have the means to upfront the cost of an electric bicycle, even though that would be the optimal vehicle for them to use. So what Bolt is doing is giving them a lease, kind of a week-to-week lease that allows them access to a vehicle, but also to the things that they need in order to keep that vehicle in service, so maintenance and things like that. So that's something that's leveraging the shift towards food delivery. It's a very specialized platform. And it's optimized for that particular task, and it's actually solving a key problem for the couriers themselves by allowing them to be more productive.
I think another company that exemplifies like where the trip economy creates opportunities would be a company called Revel Transit. Revel's a moped sharing company based in New York. They've launched in Texas. They've launched in DC. They're growing very rapidly throughout the U.S. When we first started meeting with Frank and Paul, the founders of Revel, back in 2018, a lot of questions that we would get from other people were like, mopeds aren't popular in the US. Why would mopeds take off? Culturally, compared to Europe, Americans aren't that interested in mopeds. And the trip economy has changed that, because it's not actually that Americans are just uninterested in mopeds. They're uninterested in mopeds when the proposition is that I have to buy a moped. If I can just experiment with a trip, I can quickly discover that actually it's a really fun and fast way to get around. And so by lowering the barriers to buying something, you actually increase the rate at which you can get experimental vehicles out there, and people can discover that they really enjoy one way or another. So you're actually able to increase the consumer adoption curve.
What's your sort of request for startups or request for innovation? Like what do you want to see people build in the trip economy?
I think we just like we see, a specific opportunity around e-bikes for delivery or a specific opportunity for mopeds at a moment when I think a lot of investors were very negative on it because scooters were blowing up. We think there's all sorts of different things in kind of the historic bundle of all the things that a car can do that are now becoming unbundled. And if you think about transportation, like how much each individual spends on transportation, it's the second biggest spending category after like buying their home. And so there's a huge pool of capital and an opportunity around transforming transportation, right? Like it's in the trillions of dollars. So each of these bundles, as the car kind of becomes unbundled and you have a special, better built service for one particular need or another, is still a massive opportunity from a VC perspective. So things like logistics are super interesting, and it's a sector that really hasn't been disrupted that much. All sorts of different modes of getting around cities or getting things around cities, B2B delivery of goods, the package deliveries, urban logistics. There's a lot around there. Intercity, new platforms for people getting where they want to get to, and then also connected to that is the real estate that's affected by transportation. So we see opportunities around road pricing and co-pricing and things like that, which are assets that have historically not been priced and have been used inefficiently, but there's huge opportunities there too.
Also, when you think about the trip economy, I think that we forget how many trips in the car, and Olaf, you've written a lot about this, how many trips in the car are done with pricing that's not completely transparent. Like I don't think about how much parking costs when it's free to me, or I don't think about how much the government has spent building roadways, or in some very, if you really take this to its natural extreme, how much the government has spent securing access to liquid fuels, in the Middle East, so on and so forth. When you actually start looking at all the subsidies that have gone to transportation, I think one of the cool opportunities is to find companies or to convince founders to start companies that help us take some of the money we're putting into parking or subsidies to fuel and actually bring those subsidies to other forms of transit. Like why, if I don't drive to work, should I not receive the same parking subsidy as somebody that does drive to work, even if I'm making a societally better choice, like riding a bike or taking a scooter that takes up less room, has less emissions, so on and so forth.
Yeah, and I think you're seeing these subtle kind of biases play out where in some cities, scooters are being charged a fee in order to use, access to the city. But these will be vehicles that are much smaller, much more efficient, don't do much wear and tear on the roads. And then, car owners aren't charged any of those fees and will be irate if they're charged anything. And part of the cool thing about our work, I think partly why we find it so motivating and exciting is, the two examples we listed with Revel and with Bolt Bikes, these are technologies that actually transform people's lives. These couriers are able to kind of make more money and do much better because they have access to a better vehicle. And in Revel's case, getting around Brooklyn is really expensive if you're going between Queens and Brooklyn, right? There isn't really public transit that serves that. If you want to take an Uber, it costs 3 times as much as what a Revel costs. And so we're seeing there's kind of this equity component to it, that it's a much more efficient and better and equitable form of transportation once you start solving these problems.
When people talk about the big trends in automotive or in mobility, they talk about connected, shared, electric, and autonomous. You have some thoughts on electric as it relates to autonomous, Olaf?
I think electrification is the trend that is. All of the autonomy was hyped, and now we're in the trough of disillusionment. I think electrification is the one that kind of got hyped in the mid to late 2000s. And now in kind of the productivity phase where you're seeing massive investment and massive rollout, or at least the initial stages of that happening. Not only with Tesla, which is, I think, kind of the story stock that everybody gets excited about, but what VW is doing, investing tens of billions of dollars into building out a whole line of vehicles on the new, what's called MEB electric platform. There's just massive investment that's gone into electrification, being pushed largely by regulation, especially in Europe and in China, and really transforming the entire value chain of vehicles. So if you think about a car and an internal combustion engine, there are many, many different components and pieces that have to be put together. And the cost of servicing and maintaining that vehicle is quite high. And comparing that to an electric vehicle, they're way fewer, like a third as many components that go into that vehicle. But the battery is really important, and so is the motor. And so you're also seeing a restructuring of the supply chain in automotive, which is also very complicated with lots of different suppliers creating different components of those vehicles, and different suppliers now having to adapt to the shift that's happening. One of, I think, the kind of unexpected consequences of the CO2 regulations that are being pushed in Europe right now is that a lot of the value chain of European suppliers, which are historically quite dominant, a lot of the, for instance, big German players like Conti and Bosch, are some of that value chain is being shifted to Asia, where most of the key providers of fuel, of battery cells and the battery supply chain is kind of being developed out. Countries like Korea and China and Japan. And so I think there's this unintended consequence that's happening, and a lot of European car makers are actually quite upset about this. And you see it happening, that a lot of the value is being transferred over to Asian suppliers, because the cost of the battery and that aspect of the vehicle is about 40% of the overall cost. So 40% of the total cost of vehicles is being shifted east.
I think it's not just the shift that European car makers have to be upset about. Anyone that sells a car in Europe, well, taking a step back, why are so many people developing batteries and developing electric vehicles? I think in Silicon Valley, every VC drives a Tesla and they're like, oh, naturally, it's a better car. Everyone wants it. But in reality, that's not really the case. Like, consumers aren't demanding electric vehicles. Sure, they'll say, I prefer an electric car, but when it comes down to it, it's way cheaper to buy an entry-level, internal combustion engine sedan than it is to buy a Model 3. And especially if you don't consider the government subsidies, it just doesn't make sense for a lot of consumers. So the push is actually not coming from consumers wanting these vehicles. It's really coming from these CO2 regulations, which you referenced a minute ago. And just to give people some perspective, like, this is a huge deal in the auto industry that I don't think the tech industry even is aware of. As soon as 2021, car companies selling cars in Europe could be facing fines of like $30 or $40 billion a year. Dieselgate from Volkswagen, that was like, 18 billion euros, I think. $30 billion, it's an incredible amount of money. And so they're under enormous government pressure, not pressure because Tesla's getting consumers to buy electric cars. They're under a lot of government pressure to develop EVs. So I think because of this, the development time cycles have been compressed, people having to invest a lot of money, and it may end up being that the European suppliers could lose some value to East Asia and the companies that come out there, especially for the battery development side.
So we were just talking about sort of regulation in different environments. How do you that's one element of sort of thinking about investing in different cities, because you guys invest globally. What are the other elements that are important to think about when sort of analyzing which sort of geos are better for which kinds of opportunities?
I mean, the weird thing about cities is they're often more connected than a few miles into the countryside, both culturally, but also sometimes in travel time. Like, you could go from a city and it will take you a few hours to drive into the countryside, and you can get to another city by flying in just a few hours. Then I think also some cities are quite similar structurally to others, even if they're on different continents. So a big shift that's happening in transportation is that, firstly, there's massive urbanization, especially in Asia. But even in the US, there's trends of urbanization. So more and more people are living in cities. Part of the reason people want to live in cities is because cities have historically been growth engines and continue to be. Because by bringing people closer together, there's more opportunities to basically offer goods and services, to produce things. And so there are these kind of network effects that are built into cities. And transportation is the glue that sticks all of that together. So Prescott and I actually spent a few weeks traveling in South America, meeting with a lot of the investors there, meeting with startups, and trying to understand what was shifting in that market. And what we noticed were cities like Bogota, Mexico City, and Sao Paulo were structurally quite similar in that they didn't have strong public transit backbones, and they were kind of big, kind of geographic low-rise blobs almost, which weren't very well connected. It was like these concentric circles of connectivity. There was obviously benefits to living close to other people, but kind of something interesting about New York is if you go on the subway, you can get kind of within an hour of any kind of specialist. If you need a specialist doctor or specialist lawyer, you got this kind of powerful network effect. And in these countries which kind of don't have such good transit, you don't get those benefits, and so the cities aren't as efficient in kind of creating wealth and growth. So I mean, that's one lens I think we look through cities, that different cities are structured differently, and therefore have different kinds of challenges and different kinds of problems. And a solution like Revel, which is kind of one lens we look at it through, or maybe Bolt, might work really, really well in some cities and not well at all in other cities. And so the kind of taxonomy of figuring out, what is investable and what's interesting really depends on understanding the kind of range of different cities, the opportunities and the problems that need to be solved. And again, I think what's exciting about this is if you solve these problems, you also solve major economic growth problems, because transportation is so linked to growth.
Yeah, if you ask questions like what's the purpose or why did urbanity come about, many people will say it's an economic effect. The advantages to large labor markets are that you get tons of labor specialization, so on and so forth. But as long as you don't exist in a world where you can work in VR perfectly with one another, there are huge advantages to having people that are within 1 or 2 hours commute time. And that's kind of, after 2 hours, people really won't commute every day into a job. So when you have these gigantic cities like Sao Paulo, you'd think just by the numbers, wow, this is a really large labor market. The city could actually become quite, internationally significant, which it has. But if you can't get from one side of the city to the other in a reasonable workday, then a lot of the benefits are lost. So improving the way that people can move around in urban centers is really important, which is why it's kind of a pity that there's been such an underinvestment in public transit infrastructure.
If you look I think from the perspective of America, it's quite strange to look at other countries, because America is such a spacious country. And there's been a lot of car centricity in the way things are rolled out. But in Asia, there's way less space, and also in LATAM and other places. And so I think one of the interesting developments in ride hailing, the markets where Uber, I think, really struggled were the ones that were most dissimilar to America. So if you look at Southeast Asia, you have these super dense cities, but you also have a relatively unbanked population. And so companies like Grab and Gojek saw payments infrastructure as interlinked to the problem they were trying to solve around transportation. And part of why these companies have become very successful is they're not just mobility platforms. They're much broader e-commerce platforms. Effectively, they've got delivery services. They also bring services to people. You can get a masseuse brought to you on a Gojek in Indonesia. And so once you've got this kind of massive density and kind of unique factors where you don't have the same development stages, you got certain cities and economies or countries leapfrogging what's played out in America, and therefore transportation becomes linked to things like payments, and not just to I think you kind of have an unexpected set of progressions, and that makes, I think, for really interesting opportunities in the emerging markets, because mostly people don't have access to credit. And there's huge congestion and huge challenges, but by solving that, you can solve a whole bundle of different problems at the same time.
There are companies also that make more sense in certain economies than others. The ride-hail explosion that happened in the U.S. In some ways can be described as an arbitrage where tons of Americans had cars they weren't using all the time, and they wanted some money, so they would use their cars, depreciate them in exchange for cash, right? But if you're looking at an economy like India or in Southeast Asia, where people don't really own that many vehicles, a lot of the limitations to ride-hail, even though everyone wants to use ride-hail if you don't have a vehicle, is that there's very few drivers, for example. So when you ask about what our theories are on different geographies, you can't just really apply one type of mobility model to every geography. They are quite location-specific.
Yeah, and I think also like in India, for instance, the cost of having somebody drive you is much lower. Yeah. So you might use, Ola as a default for getting around, whereas in the US, minimum wage and the cost of labor is much higher. So it may only make sense for a certain demographic of people living in a certain kind of area. Yeah. So you have people, for a bunch of reasons, kind of leapfrogging car ownership and just using mobility services. And so I think that's kind of an interesting trend.
It's a company in Pakistan, Airlift. Are you familiar with it? Sort of like a smart bus network. I think it competes with Careem.
Yeah, and in India, I think there's one called Shuttle, and there's one in Egypt that's come up. I mean, I think this theme around what is public infrastructure and what is privately rolled out is really complicated. I think LATAM is one area where it's particularly interesting because governments haven't done that much to build out that infrastructure. If you go to India, the metro has been rolled out into lots of different cities, but that hasn't really happened so much in cities like Bogota or Mexico City.
I think it's an interesting actually opportunity to bring up a tension we see a lot where people are like, oh, you invest in mobility, that means you are anti-transit or anti-public investment in transportation infrastructure. And that's not the case at all. I think that when people see a tension between Bird and Lime or Uber and Lyft and public transit, they have to also look at the opportunity for governments to act as orchestrators and to say, okay, if we want certain outcomes or objectives, how can we use some publicly owned infrastructure? How can we subsidize some privately owned services to get those objectives? And I think actually, if you look at what some of these companies in Mexico City are doing, there's a real opportunity for the government to say, okay, yes, we do need a better subway system. But between now and 10 years from now, what are we going to do as that system is being developed? Like, there's an opportunity for them to work with these private networks and actually provide a lot of relief to the commute congestion that people are facing.
Yeah, and I think when you think about what we're doing as a VC and investing in this kind of space, it's not exactly tech in the sense that, like, I think the kind of idea of tech is like, .com or SaaS businesses or something where it's purely digital. And it doesn't really interact that much with the physical world. I mean, I think these kinds of tensions that Prescott's highlighting around regulators and conversations with them and trying to find a way to partner with them kind of highlights this unique challenge here, which is these vehicles, these scooters that ride around on city streets or vans, they're not just in a digital realm. They're actually interacting with the physical world. They're taking up space. They can crash into people and even kill them. And so regulation is unavoidable, and having strategies around regulation is critical to a lot of the companies we back. And so that's one key lens that we're looking through. So there's obviously a tech component. Yeah, there's scalable digital aspect to this that solves a unique kind of problem in each case, and allows defensibility and something to become extremely valuable, hopefully at the end. But there are also unique challenges, not just around regulation, but also that these are heavy assets. They need to be financed oftentimes. And Prescott kind of highlighted this in the case of Uber. There's a certain kind of offloading of the assets to the driver partners. It's not super efficient, actually, because they're all paying for their leases as individuals rather than getting economies of scale. You see a similar but different problem for scooter companies. The valuations have shot up in part because they have to own lots of assets, even though those assets depreciate rapidly. So we think a lot about this kind of asset piece and debt financing around it, that I think is a unique challenge in our space, but also an important opportunity for us.
Do you have a framework for when it makes sense to own the assets versus at least be asset light?
It's a question of how the value chain is structured. I'll try to break this down in a way that's not too convoluted. So if you look at there's people that make cars, there's people that will probably own cars, there are networks of people that will drive those cars, and there's sources of demand. If you own a car, it wouldn't make too much sense for you to only serve Uber in the US. You'd want to serve Lyft if it was better for you at 5 p.m. than Uber. If you live in an economy where there's only one source of demand, let's take China as an example, where the only person that you'd be driving, the only network you'd be driving for is Didi. In that case, it actually might make sense for the asset to only serve Didi. And if you actually look at what those kind of monopolistic scenarios look like, if you go to China, you actually see Didi getting involved in the mass acquisition of vehicles and the creation of these fleets. In fact, they even have a partnership with like tons of automakers like Kia and Volkswagen and others, where the car companies are designing cars for ride hail. They're going to sell them into fleets dedicated to work with Didi. That wouldn't quite.
And that ties into the electric vehicle regulations in cities in China, where there's limits to non-electric vehicles, but a lot more freedom for electric vehicles. So you see those incentives kind of tying in. But I think, in general, if you want to scale a company really rapidly, I think there's been this weird distortion in the market because of SoftBank basically adversely selecting companies that are asset heavy. If your filter is this company in need of $100 million or more, then you're going to, I think, select for companies that are asset heavy. But if you want something that I think is more sustainable or defensible, it makes sense to try and offload or separate out the asset and the debt that's associated with it from the network, which is the scalable part, the part that's tech and the parts that's heavy assets. We ideally try to separate those out. I mean, something I think that's been key to the success of Revel and other companies that we're backing. We think about it across the board how to do it, but it varies from company to company. We've got a company, for instance, in Spain, which does car subscriptions, but they have partnerships with leasing banks or with OEMs in order to finance those assets. So it's a different debt provider, it's a different person kind of holding the asset. Lots of ways to structure it, but having a game plan around that's pretty critical.
It speaks to an interesting change that's happened over the past few years in Silicon Valley, where it used to be that being a tech company meant I'm going to make software for somebody to run their business better. And now that there's just more and more and more money coming into the Valley, people ask you, okay, well, if you had 50x the amount of money, why wouldn't you just, speed up your time to market by, instead of selling the software to other people to run their business better, just buy their business and run it for them? It's almost, you're looking at things that almost look like PE roll-ups, where you have a tech startup that has a little bit of IP and can manage things ostensibly more effectively, raising a lot of money and kind of competing directly with who 10 years ago might have been their customers. Now they're just going full stack. And it could produce some pretty interesting go-to-market strategies, but it could also mean that you have lots of companies that are wasting lots of money on assets that it's unclear whether they can really manage them better or not.
But I think also part of the reason we're seeing this is a lot of the low-hanging fruits of kind of SaaS and super scalable business models, just purely software, have been plucked. And so the companies that have become valuable over the last decade have, across the board, many of them have been in touching on assets to some extent. So obviously the ride-hailing companies and scooter companies are great examples of that, but also a company like WeWork. Sorry, not WeWork. WeWork is a much messier example. I meant to say Airbnb. Is a company that's dealing with the other expensive asset that most people own, which is a home or an apartment or something like that. WeWork is, we're literally sitting in a WeWork right now, but I think it's actually, I think what makes WeWork interesting is it's kind of at the limit of what this model allows, which is there has to be a component that's defensible and can be scaled super quickly, and it can't just be an asset leasing business. It can't just be something that changes slightly on an existing business model that hasn't been trading at super high multiples.
Do you have a framework for thinking about when or how to evaluate sort of whether incumbents will win or startups?
We don't have a set rule where like incumbents will win or startups will win. I think it depends on the type of business. Let's take ride-hail as an example. The crazy thing about Uber is that everyone thinks it's a business that's never going to make a profit. I see a clear path towards profitability, and that path is ending its constant price wars in other geographies. And interestingly enough, local players in geographies like perhaps like India or Latin America will succeed because the public market is just not going to sustain Uber's appetite for nonstop price wars.
Part of the reason why Uber and Didi and Grab have raised so much money is because we've had a kind of historic period of low interest rates, and so the cost of capital is not so high. So the cost of pouring subsidies into markets in order to get growth is also not so high, relatively speaking. That doesn't mean this can happen endlessly, but I think now we're seeing a pullback on that and some kind of correction. And so these companies are also correcting. And when you have a duopolistic model as you have in the US, I don't know if you've booked airline tickets recently, but they're usually kind of in lockstep, especially in between US cities. Like all the airlines are somehow pricing things exactly the same. I think Lyft and Uber do pretty much the same thing. And once they kind of stop subsidizing as much and start kind of getting more of a profit, I think they can do that pretty scalably across markets. Like there's a question as to how much consumers are willing to pay for these kinds of services, but I think in many cases they're willing to pay enough in order for these companies to become more profitable.
So to address the question, I think in the case of like a ride-hail scenario, I wouldn't be too surprised to see upstarts in other geographies successfully beating out some of the incumbent ride-hail players because of those incumbents' inability to suffer losses forever in these far-flung geographies.
But what's interesting about ride-hailing that wasn't clear at the outset is that the network effects are real, right? Like in a city level, having a certain amount of vehicles is critical in order to have a wait time that's low enough. Like 3 to 4 minutes is kind of the magic number. But once you've hit 3 to 4 minutes, there's not that much of a competitive advantage to having, 2.5 minute or 90-second wait time for an Uber versus a Lyft. Like as long as the price is kind of comparable, you're willing to suck up the extra minute and a half or so. And so it's not these uncapped network effects. They're real, but they're not unlimited. I think we're still kind of figuring out exactly how this plays out in the scooter market, but I think the network effects are even weaker. I was actually talking to Marcus Willig, who's the CEO of Taxify, now rebranded as Bolt, which is, I think, the second biggest player in Europe right now. And he's interesting because he started the company at the age of, I think, 19, and he did from Tallinn, Estonia, and kind of did a spreadsheet analysis and came to this realization that, as long as you got good enough service, you could be the second biggest player in the market. And if you're going to do that, what you should really optimize is the cost of your infrastructure, your engineering, etc., in order to build this platform. And so I think they've done really well in kind of capturing market share. Even though they came to the market much later, they've been much more capital efficient.
So it's not winner take all, because people thought at some point these were going to be winner take all market.
Yeah, it's winner takes something, right? But it's not winner takes all. I think in some cases it's even less, like with scooters, kick scooters at least.
On the other hand, there are other markets where I think the incumbents have a distinct advantage. I mentioned before we started talking here, if somebody's approaching us with a full stack autonomous play, the bar is very high because it's, short of some sort of complete breakthrough in the fundamental way people are doing training, etc. The cost of developing these types of systems to rival the performance that you're seeing from a Waymo or even, a distant second like a Cruise or something is just so high that even the incumbents can barely afford their own costs. I mean, you're seeing a lot of JVs and not mergers, but partnerships where multiple OEMs each individually agree they can't sustain billions of dollars of investment into this AV technology. They're going to join forces. So I do think that's an example where, startups can sell into a particular part of the software stack, a particular sensor, a particular type of, software that goes into the development of autonomous vehicles. But for somebody to come in and say, I'm a startup and I'm going to tackle this, reputable VCs and smart founders are still trying to do it, but I'm of the opinion that it's very difficult.
Yeah, and I think our strategy in investing in these kinds of companies, we made an investment in a company called Cognata, which does simulation for autonomous vehicle development. We made another investment in a company called Phantom Auto, which does teleoperation remote control. And they just announced a partnership with Postmates doing these sidewalk delivery robots. And if you're going to, so as you kind of build out more of these kind of vertical stacks of autonomous players, then you can start supplying solutions across those players. And as long as it's a solution that it makes sense to be really focused on and can be separated from the core engineering. So actually Phantom's taking an approach of building out an SDK that allows customers to basically then integrate it themselves. You can come up with smart strategies for partnering with these companies. And there are pretty big problems that still need to be solved. But you kind of have to have a broad market perspective on this in order to, I think, separate out, opportunities that are fool's errand and just going to throw lots of capital at them versus opportunities that I think have some kind of defensibility.
Let's say 10 years from now, you've come back, we're doing another podcast. I'm curious to get just a few minutes of your sort of hot takes of what do you think the bull and bear case for some of these companies and which you think are most likely to like, how do you think this is all going to shake out, or how could it all shake out?
Uber's trying to become more of a platform and integrate third-party services, and basically they just had this partnership with Cityscoot in Paris with electric mopeds, and have a partnership in India on public transit. They're trying to kind of embed themselves and make themselves less replaceable. So I think Uber doesn't go away, and I think, like Prescott said, these companies have a path towards profitability.
Lyft too?
I think Lyft even more so has a clear path to profitability in the US. It's not fighting a war with Didi in Latin America, for instance. I think the US market's kind of stabilizing out.
I think there was this perception that whoever makes the first autonomous car will put every car maker out of business, every Uber out of business. And I don't think that's just not true, because you're going to have, back to the value chain questions, multiple people manufacturing cars, multiple people that have reference designs to make those cars autonomous. But each asset has to serve as many demand sources as it possibly can. So there's still, it's just like the hotel industry. There's still a room for direct bookings if you're going to go to a hotel versus if you have, an Expedia or a booking.com. People are going to be there generating consumer demand and fulfilling that demand by going to any number of people that manage fleets of autonomous vehicles. So I don't think it makes sense to merge the fleet owner with the demand source. For example, if Uber had a whole fleet of autonomous vehicles, but Uber didn't have very much demand at 5 p.m. on a Thursday in, I don't know, some city, would those vehicles then be able to serve Lyft demand? It makes sense to separate the ownership from the demand source. And I think that Uber and Lyft will continue to look kind of like Expedia, Airbnb players. And there'll be other people that actually buy, maintain, manage, and service the fleets of autonomous vehicles. It'll be a different kind of value chain.
So who's going to be the big winner and who's going to be the big loser? If not specific companies, what types of archetypes?
I think the demand players will always be really large. Probably the people that make the reference designs for how you make an autonomous car. There's definitely a role for large people to act kind of like contract manufacturers. I mean, Foxconn is a huge company, and all it does is...
Is that what the OEMs turn into?
I think some OEMs are at risk of turning into this, but a lot of OEMs have a good shot at actually being the real technology vendors.
Yeah, going back to kind of the high-level story of OEMs, there's a lot of OEMs considering... I mean, if you think about Boeing and Airbus, they're the main two OEM manufacturers of airplanes. If you look at cars, they're like 14 or 15 companies that are selling more than 1 million vehicles a year. With the PSA-FCA acquisition merger that's happening right now, you're starting to see some consolidation. There's a lot of pressure coming on the market. I think you're going to have a lot more consolidation. But again, tying this into the political aspect, if you think about the financial crisis, like the US government bailed GM out because there's so many jobs at stake in this industry. Governments are actively involved in supporting these companies. And so there's a lot of complicating factors that aren't just business logic as to, whether companies fall or not and how they weather difficult economic times. I think there is a key challenge, though, for the OEMs of how they capture more value and how they evolve their businesses to become digitized. Because for the most part, they're basically assembling different components and forming them into a vehicle that looks really nice. But what digitization does is it doesn't work in such a kind of Lego building block linear kind of way. It makes all these kind of connections that are less expected, which creates new opportunities. But if your org chart is structured around very high volume, reliable manufacturing, then getting your head around that and adapting your business process to it is quite a challenge. That said, I think what the OEMs have done over the last 5 years that we've been involved in the space, and we work closely with many of them, is really commit to transforming their businesses. I think everybody went to business school and studied Kodak and examples and IBM, companies like that, and learned lessons that at least it's much better to do something than nothing. It's hard to figure out the exact strategy and what these businesses become. I think it is clear, as Prescott highlighted, that you're going to need manufacturers. Like that part is, and they should really make sure that at a basic level, they do at least become Foxconn. Foxconn's a multi-billion-dollar company. It's well positioned in a certain sense, but it has low margins. So how do you increase the margins? Right. But they're already low margin businesses.
Yeah. And who owns the demand side?
I think one thing that's interesting is maps. There are not that many maps in the world. There's like TomTom in here, which is owned by a whole lot of, it's like a consortium of German car makers and suppliers. And then there's a company in San Francisco called Mapbox, which has actually grown really well. And then there's Apple and Google. And those are the main maps that you can use.
And maps wonder why maps didn't win. Why instead of going to an app called Uber, I don't go to my apps and then order a car from there?
Well, Google Maps has started doing some of the aggregation. You can at least search some information around ride hailing and scooters and find them on a map. I think Google is trying to shift more to that platform. And you see in China, companies like AutoNavi becoming, platforms in a much more kind of concrete sense. So I think you're going to see more of a shift toward, just like messaging, especially in China, has moved to a platform approach, and iMessage, which is not great in any respect, and WhatsApp and other things are trying to imitate and learn lessons from that. I think because maps, I think this transformation's happened slowly, in part because there's so few players and maps are used for so many different things. But I do think there are extremely powerful effects around maps because you got really strong network effects. All the point of interests, you're going to get more people using the platform. Therefore, you have more information. You can feed that back into the map.
With great power, I think also is going to come great scrutiny. In the current environment, the tolerance, I think, for U.S. authorities to be happy about a super app is increasingly questionable, I think. And you look at the ongoing war between, Priceline, Booking, and Google. They're the biggest spender of ads on Google search, and yet Google's trying to, actually get people to book hotels through Google Maps. There's a lot of gunpowder sitting around. Somebody can drop a match and start a gigantic war between these companies.
Well, and look at Uber, right? Like literally had a gigantic war with Uber because I think Travis Kalanick realized one day that if Waymo was successful in building an autonomous vehicle, the demand source is Google Maps. Like you open Google Maps whenever you want to make a trip somewhere because you're looking, and if they just offer you a vehicle there, who needs Uber?
And hence Uber's sort of trying to be a platform.
Uber definitely wants to be the Expedia, not the United or American Airlines.
And some of Uber's acquisitions, like Ducato, right, were in order to build up their in-house mapping capabilities, just like Apple realized, I don't know, like 8 years ago, and struggled initially a lot that they needed maps. It was critical. They were dependent on Google. They couldn't afford to be dependent. It was a key part of their platform. I think even more so if you're a ride-hailing company, you realize that just depending on Google is quite risky.
But just as like regulators could prevent a super app from arising, I think they could also prevent Uber from owning all of transport. Like they want to be the transport graph, for example, right? So in my view of Transit app and many of the other kind of meta search apps, they have a lot to gain from regulators saying, listen, you can be a scooter company in our city, but you have to list your scooters, not just on your app, but you have to list them in Google Maps. You have to list them in Transit app. And it will actually probably be the role of regulators to ensure that there's an open data standard that allows people to have interoperability. Again, transportation, more so than many other digital domains, is an area where governments are really careful about ensuring that citizens don't get screwed because they're so dependent on a particular company. So it's an area we expect to see a lot of activity there.
Again, referencing Latin America, a lot of the political instability in Latin America is linked to a slight increase in public transportation fares, right? Like people are very sensitive to the cost of public transit, and in many different geographies, and so there's a lot of, again, it's a real world thing. It affects everybody. It doesn't just affect early adopters, and there are real consequences to it.
Who loses here? From this conversation, it could be interpreted that everyone wins, but do all the Zooks, etc., are they in a tough spot, or like who do you think gets in a tough spot?
Makers of catalytic converters are not in a good position. Or other
piston heads,
spark plugs. No, I mean, I think a lot of suppliers are in a tough spot. Like I said, there's this huge shift in value chain in Europe. If you're shifting towards EVs, you're shifting away from internal combustion vehicles. The shift away from diesel has been faster than people expected, and so there's a lot of companies that I think stand to lose a lot. That's just from one shift that's happening, which is in the powertrain.
What about Tesla? What about Apple?
But it's also not a zero-sum game, right?
Yeah.
Because I think it's important to remember that when you think about congestion is a consequence of people wanting to make more trips than they can, and that actually impairs value creation. If you could make more trips in Bogota, it could be a city more like New York in the sense of more economic development, more access to specialists, rapid development cycles. And so if you solve some of these problems, you can actually, and I think the metric that's really interesting from a congestion perspective isn't whether or not there is congestion. There's a lot of hand-wringing about whether autonomous vehicles will or will not, in fact, increase congestion. Like there might be like numerically more traffic jams and yet more people getting to where they want to get to. And the getting to where you want to get to may actually be the most important thing, because that's a trip that's completed. And often that means, a parent being able to send the child to a better school or being able to work a better job. And those are actually things that,
those are the outcomes people want.
Yeah, I think that's the outcome society should want, and what make cities economic engines.
And who wins in micromobility?
I think the interesting thing about micromobility is, we talked about how the trip economy allows people to experiment and allows consumer adoption curves to be really steep for new vehicle formats. Within vehicle formats, what's cool is to see how fast the iteration has been. It could take generations, like literally 20, 30 years, for cars to have as many improvements and iteration cycles as you've seen in the scooter market in the past 2 years.
And it's partly because of regulation and partly because of complexity. But the scooter companies are kind of vertically integrating the platforms. But to the Revel point, like a lot of the shift that's happening in the way in which kick scooters are being redesigned is to make them more robust, to add shock absorbers, to add a seat, which increasingly makes it look more and more like a moped, right?
Who's going to win in the micromobility race? I actually think who's going to win are basically livable, walkable downtown sections of cities. Retail, anyone that has a business that involves people being out and about in cities. I think they all benefit from people getting out of single occupancy vehicles onto small electric vehicles where they're exposed and they can talk to people around them. They can discover things. Anyone that's ridden a scooter knows it's just way more fun, and you're more likely to take a 5-block trip than if you had to unpark your car, sit in traffic, find parking. There's just going to be more economic activity because people can do more things in cities.
And again, it's not a zero-sum perspective, right? You could have a whole lot of scooter companies all being successful and having large businesses, and the trips they're serving aren't, some fraction of them might be taken away from cars or other forms of transit, but many of them will be new trips that wouldn't have been possible beforehand, and therefore businesses also benefit because there's new customers that are coming that wouldn't have come otherwise.
And don't, I guess, mistake our answer to mean that we don't think there's going to be losers. Like, there's probably already today a wasteland of scooter companies that have launched, didn't have the right product, but I mean, it's the creative destructive process of the capitalist system, right? You see people try to offer a new service and neither consumers want them or not, or they have a set of economics that work or don't for their service, and that's
right.
That's fine.
What about horizontal companies like simulation companies?
We also have an investment in a simulation company, and I think with autonomous vehicles, they're harder than people expected. And so that's good for both of these companies, because if it's a harder problem, then you're not going to just be able to hire all the engineers in-house. You might want to work with a company that's specialized in developing a solution. And so I think the key question is, what are the problems that can be solved by specialized companies? Are they really hard to solve? And is there like meaningful defensibility if you succeed in solving that? And I think that's definitely true in simulation. It's a really complicated and difficult problem. But there's also advantages to, having more customers. You're able to invest in a better product. There's a certain kind of complexity around the mapping that's required also to build a simulation, which I think will long-term give these companies defensibility and make them kind of essential suppliers into this value chain. If you think about smartphones, right, when they originally built out, the number of suppliers feeding into that value chain was way fewer than they are today, right? Over time, you got more and more companies that start offering, and it's not just, the component manufacturers that are offering services, or actual components that go into these phones, but you've got companies like Snapchat that are built on top of that platform. And so I think this is also an interesting theme around the shift that's happening around digitization of vehicles, is that they're becoming more like software platforms, and on top of that, you can offer certain kinds of services. I think the extent to that is still to be determined, and I think the number of the ability of car makers to adapt their platforms in order to be more inviting to third-party developers has a long way to go. There's like one app that was built for all the different models of cars, which was Pandora, but they basically had to build a separate solution for each of the infotainment systems for cars. Some manufacturers of vehicles have multiple different operating systems. If you compare that to smartphones, you've got Android and you've got iOS, and then you basically got most of the world's population able to download and use your app. And the automotive industry is so far away from that in terms of, software platform scale. that there's a long way to go, but I do think there's an opportunity there.
My guests today have been Prescott and Olaf from Maniv Mobility. Guys, thank you so much for coming on the podcast.
Thanks so much for having us.
If you're an early stage entrepreneur, we'd love to hear from you. Please hit us up at villageglobal.vc/network catalyst.